Gold and US stocks jump back to near their record highs. China is on track for 5% GDP growth this year, with production and exports still going strong, despite all sorts of tariff drama. That's coming up in our 5 Things in 5 Minutes on Tuesday, October the 21st. And then, in part 2 of a deep dive interview, ANZ's head of geopolitical risk, Cameron Mitchell, talks about a new era for geopolitics and trade.
The US has gambled on the idea that the US economy is so big, it's the biggest consumption economy on the planet. There is no alternative to that market. I'd argue that that gamble at this point has paid off relatively well for the United States.
But first, in 5 and 5 with ANZ, China is on track to achieve its 5% GDP growth target for 2025, after reporting 4.8% growth in the September quarter, as its factories kept churning out stuff and then exporting it, despite all the drama around Trump's tariffs, says ANZ's Greater China chief economist Raymond Yung.
The September number once again tells us that the Chinese export is quite resilient, and basically telling us that the Chinese supply chain is very difficult to be replaced despite all the noises from the trade tension. The Chinese factories continue to be running, with the industrial production number in September rising 6.5%, which is a very, very strong number. And I also expect that the export will continue to be very solid, because think about that, if iPhone 17 is quite popular and it's also a major item of Chinese export, that and related product to the new model will also support the Chinese export as well.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 1% and the Nasdaq was up 1.4%. The US 10-year Treasury yield fell 2 basis points to 3.99%. West Texas oil futures fell 0.9% to $57 a barrel. Gold rose 3.5% to $4,361 an ounce. The dollar index, the US dollar index, was up 0.1%. The Aussie dollar rose 0.3% to 65.15 US cents. The Kiwi rose 0.4% to 57.5 US cents. Number 2. So China's still growing solidly, but is it managing to switch from investment and production to consumption and spending? Here's Raymond again.
One of the monthly activity figures caught my eye this morning is the fixed asset investment, which has this number contracted 0.5 percentage point in the first 9 months. And it's the first time I've seen a negative number. If we ignore the pandemic period, this is the first negative investment number from China. But also, we observe some contraction in manufacturing investment and infrastructure investment that is largely intentional because of the anti-inflation campaign by the government and asking factories not to invest that much. Even though on the surface, we can also call this, shifting from an investment-led economy to a consumption-led economy. But what we actually see is the strong government intervention asking factories and manufacturers not to invest that much this year.
Number 3. So are China's consumers picking up the baton? Raymond says retail sales growth of 3% in September remains modest and was down from 3.4% the previous month.
And again, this is because of the property downturn, the negative wealth effect that continue to dampen household sentiment. It is hard to see meaningful recovery of retail sales as long as this property downturns continues.
Number 4. New Zealand's annual inflation rate rose from 2.7% to 3% in the September quarter, which puts it at the top of the Reserve Bank's 1 to 3% target range. But the rise was in line with the Reserve Bank's forecasts, says ANZ senior economist Miles Workman, and inflation is expected to ease back in the coming months.
The bottom line here is it was basically bang on with the Reserve Bank's August MPS forecast, suggesting that the Q3 CPI data doesn't move the dial one way or the other in terms of the Reserve Bank's next move. Now, that doesn't mean they're going to be happy about the acceleration in inflation, but it is at least evolving as they expect, which means they can pay attention to some of these other timely indicators.
Number 5. The biggest driver of New Zealand's inflation in the quarter was non-tradable inflation, which was 3.5% in the September quarter from a year ago. Here's Miles.
A big driver of non-tradable inflation currently is coming through council rates. So they lifted 8.8% quarter on quarter, and they contributed quite a lot to headline inflation, 0.3 percentage points of that 1% rise. So look, the upshot here is this is a part of the CPI that's really not sensitive to interest rates, and it is remaining quite elevated.
Miles Workman there. Now, in part 2 of a deep dive interview, I spoke about a whole new era in trade and geopolitics with ANZ's head of geopolitical risk, Cameron Mitchell, on the fringes of last month's AFR Asia Summit in Sydney. In part 1, he talked about the new Turnberry era, named after Trump's golf course in Scotland. So I asked him how long might it last, and if businesses have started to embed the model into their longer-term plans.
Look, I think it's fairly mixed, of course, depending on the customer, depending on the market in which you're talking to the customer, and of course, depending on the sector in which the customer is working. But broadly speaking, I think there is a consensus now that yes, tariffs probably are here to stay. There's a sense of optimism or hope, perhaps is the better word, that the legal proceedings in the United States, 2 courts now have judged the tool that Trump has been using for a lot of these tariffs, IEPA, as not appropriate. But again, you'd probably have an equal number of people thinking, well, even if that is struck down in the courts, there are other tools at Trump's disposal that he can use to keep tariffs in effect to roughly the same level. So I think the tariffs are here to stay is probably well understood. The bit that's not understood, or at least the bit that there's far less consensus on, is so what? So what are these tariffs actually going to do? There is a lot of confidence in the Trump administration, of course, around the tariff receipts. We're hearing Scott Bessent talking about originally a $300 billion windfall this year. Now he's revised that up to $500 billion. I think the Congressional Budget Office has released a report that talks about potentially a $4 trillion windfall over the next 10 years. But that's the bit that's not well understood. And I think the other key aspect where there's big debate is who's paying for these tariffs.
So far, it seems that the exporters and the importers, but not necessarily the consumer, are paying through lower profit margins. But will that stick?
That's the big question, Bernard. So I think the Trump administration's rolling on this sugar hit that they're getting from the tariff receipts. And the question is, how long will that last? And when does the US consumer end up wearing some of the costs? There's a political dynamic to this, of course, in that I would assume the president is hoping that those impacts, if they ever come, will be after November next year, which of course is the midterm elections. So I think there's a little bit going on here. You're right. I don't think there has been a big flow through of costs to the consumer just yet. I'd say probably will occur at some stage over the next 6 months or so. But I'm also not sure that it ends up being that sort of binary, the consumer will pay everything. I have a feeling that it's almost like treacle falling down a wall, and it's going to sort of stick along all of the 3 aspects: the producer, the distributor, and then of course the consumer at the end of the line.
The other discussion here is that there's a resolution amongst Australia, many parts of Asia, to stick with the global rules-based system and to, in a way, double down on free trade, at least between everyone else except the United States, which is different to the last time we saw tariff rates at these levels for the United States, when all the world were tit for tat with tariffs. This time around, it's just the US applying the tariffs, and everyone seems to have held back now. Is that resolution going to stick? Are people going to avoid getting into a spiral?
Yeah, look, I think, as you rightly pointed out, that's the key distinction between the last time there was a tariff regime in effect, where it was a race to the bottom for who could tariff each other as quickly as possible. I think in this current global economy, the US has gambled on the idea that the US economy is so big, it's the biggest consumption economy on the planet. There is no alternative to that market. So therefore, our trade partners have to eat the tariffs. I'd argue that gamble at this point has paid off relatively well for the United States. There have been tariff levels that have been levied, exemptions, of course, that have been carved out. And for the most part, the US hasn't had to hand over anything in return. These are just 15% or 10% or sometimes 19% tariffs or more, and there is nothing that the US has had to do in response. Now, that's where we're at today. I would argue that we are in a bit of an early days process here, and there is a risk of overconfidence in the US that this tariff approach can continue without any consequence. And of course, the risks are the more confident you are, the more risks that start to present themselves. But at the moment, it seems to have worked, at least as far as Washington is in terms of the receipts that Washington is looking for.
Cameron Mitchell there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, October the 21st. Coming up tomorrow, we'll find out more about how confident Australian consumers are. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.